Welcome to the Deep Dive. We're taking a close look today at something absolutely fundamental to the Indian economy, its banking system.
It really is.
Yeah.
It's a fascinating subject, quite complex, but, vital. And it really reflects India's unique path over the decades.
Exactly. And we've got a stack of information you've shared, articles, research, your own notes, diving deep into this topic. Our mission right now is to pull out the most important insights, the key nuggets of knowledge from all this material.
Right. Think of this as your shortcut, sort of, to really understanding this crucial sector.
We want to uncover some surprising facts, maybe, and give you enough detail for a solid grasp, but present it in a way that's engaging and easy to follow. This is your custom exploration of India's banking landscape.
Yeah, make it accessible.
So what's on the map for this deep dive? We're starting with the absolute basics. What does a bank actually mean in Indian context? And we'll zoom out.
Look at the structure.
Exactly. The structure of the system, the powerhouse that is the central bank, the different kinds of banks you'll find.
Yeah.
The massive reforms that reshaped everything after 1991.
Huge changes then.
Yeah. And how the economy's vital flow of money, its liquidity is managed, the critical ongoing efforts to bring everyone into the financial fold, financial inclusion, and finally, some of the persistent challenges, especially around asset quality or what are known as non-performing assets, NPAs.
It's quite a journey, touching on everything from, high finance and global norms, right down to the daily lives of farmers and small businesses.
Okay, let's unpack this, starting with that fundamental question. What is a bank in India, based on the material we have?
Well, at its heart, the sources describe a bank as a financial intermediary. It sort of sits in the middle, connecting different parts of the economy.
An intermediary, that implies a kind of dual role, doesn't it?
Precisely. On one side, it's an intermediary between people or entities. It accepts deposits from individuals, businesses, maybe other institutions. People put their money in the bank.
And get interest, usually.
Right. The bank typically pays them interest for holding it. So it gathers funds from those who have a surplus.
Okay. And the other side of that coin?
It acts as an intermediary within the economy itself. So it takes those pooled funds and directs them towards productive purposes.
Right.
Lending money for things like expanding factories, investing in new technology, starting new businesses, or, say, diversifying into different markets.
And that's where the bank makes its profit, by charging interest on those loans that's higher than the interest they pay on deposits.
That's the fundamental model, yeah. This process, accepting deposits, using those funds for lending, earning a profit, that's the core activity of what we call commercial banking.
The material also points out that the structure of banking in India really mirrors the country's mixed economy. What's the practical outcome of that?
Well, it basically means you don't have just one type of system. Instead, you have this blend of ownership structures, different types of institutions, all operating side by side.
And the main categories mentioned are public sector banks, private banks, and foreign banks.
Those are the big buckets, yes. And the sources really highlight the sheer scale of the public sector, noting there were, 21 public sector banks at the time the material was compiled.
21. Wow. That number alone gives you a sense of the state's historical footprint in finance.
It really does. And the material emphasizes that, look, regardless of the type, public, private, foreign banks collectively play an absolutely vital role in overall economic growth.
Because they're the pipelines channeling money from where it is to where it can be used to create wealth and jobs.
Exactly. Essential for capital formation, for investment. But, this current system wasn't always this way. The sources really underscore that pivotal moment in 1991 with India's liberalization policy.
Ah, yes, a period of huge economic opening up and change.
Which, naturally, necessitated a corresponding transformation in the financial sector. So significant reforms were kicked off, largely based on the recommendations of the Narasimham Committee.
Why were those banking reforms so crucial specifically then at that juncture?
Because, as the sources describe it, before 91, the banking sector was, highly sheltered, highly regulated, almost like a protected industry,
Not really set up for competition.
Not at all. It wasn't designed for a dynamic, competitive, and increasingly globalized economy that India was moving towards.
So the reforms were essential to bring banking up to speed, right? To support the growth of the private sector, which needed access to finance, and just generally make the system more efficient, more resilient.
Absolutely. It was all about modernizing and enabling the financial sector to act as a true catalyst for the liberalized economy's growth.
And overseeing this entire complex system is one powerhouse institution.
That's the Reserve Bank of India, the RBI. It's the supreme monetary and banking authority. It pulls the strings, sets the rules, controls the flow.
It's even called the Reserve Bank because it holds the reserves of all the commercial banks. It's quite a descriptive title, actually.
It is. And it was established quite a while back, April 1st, 1935, under the provisions of the Reserve Bank of India Act, 1934.
Pre-independence origin, then, and its central office moved.
Yeah, initially it was in Calcutta, but it made its permanent home in Mumbai in 1937. And that's where the RBI governor sits, where the big policy decisions are formulated.
And its ownership structure changed hands, too.
It did. Initially, it was actually privately owned, but then it was nationalized in 1949, and it's been fully owned by the government of India ever since.
So it functions as the government's central bank, and the sources list multiple hats the RBI wears.
Oh, many. It's the apex bank, so it's at the top of the hierarchy. It's the banker to the government, handling their finances. It's the banker to the banks, providing services, liquidity support. And it is, crucially, the monetary authority controlling the money supply, interest rates, that sort of thing.
Okay, let's try and map out the actual structure then. The different layers and types of banks operating under the RBI's gaze?
Right. So the broadest classification, the first cut, divides banks into scheduled and non-scheduled banks.
What defines a scheduled bank? What does that mean?
It's literally a bank that is listed in the second schedule of the Reserve Bank of India Act, 1934. It's a formal designation, basically.
And there are specific criteria to get on that list.
Yes. The material specifies one key condition. They must have a minimum paid-up capital and reserves of at least $500,000 rupees, 0.5 million. And importantly, they have to satisfy the RBI that their affairs are being run in a way that doesn't harm depositors' interests.
Makes sense. And non-scheduled banks are simply the ones that don't meet those criteria or just aren't listed.
Correct. Now, within that scheduled category, the material then breaks them down further into two broad types, commercial banks and cooperative banks.
Okay.
And the focus, as we kind of touched on earlier, is primarily on commercial banks because, well, they account for the lion's share of the banking business in India.
Right. So diving back into commercial banks, we already touched on the basic definition. Financial organizations dealing with deposits and loans, particularly for businesses.
Yeah. And their activities are pretty much what you'd expect from everyday banking services. Issuing checks, drafts, accepting term deposits, providing various types of loans like installment loans or overdrafts, offering different accounts like checking or current account savings, and fixed deposits or time deposits.
And these are generally run for profit, owned by private individuals or groups.
That's the commercial model. Now, the schedule of commercial banks, SCBs themselves, are further divided into 5 categories, mainly based on who owns them or how they operate.
Okay, first, the big ones we mentioned, public sector banks, PSBs.
Right. Here, the majority ownership, the controlling stake, rests with the government of India. The sources give examples we all know. State Bank of India, SBI, Bank of India, Canara Bank.
The material highlights a unique historical context for SBI, doesn't it?
It does, yeah. SBI and its 6 associates, before the big merger happened later, were initially treated as a distinct category. This was because of specific acts of Parliament that govern them, like the SBI Act of 1955 and the SBI Subsidiary Banks Act of 1959.
So they weren't just nationalized in the same sweep as others?
Not initially in the same way, no. They were kind of their own thing first. They were only later grouped together with the other nationalized banks to form the overall public sector banks category we see today.
And IDBI Ltd was also brought into the nationalized banks group from December 2004?
Correct. It joined that fold.
Then you have the private sector banks.
These are where the majority of the share capital is held by private individuals or entities, not the government. Legally, they're structured as companies with limited liability. And the sources mention prominent examples like ICICI Bank, Axis Bank, HDFC Bank names we hear all the time.
And there's a distinction made between old and new generation private banks.
Yes, the new generation banks are those that came into being after the 1993 revised RBI guidelines. These guidelines essentially opened the door for new private sector banks to be set up, which was a key part of the post-reform landscape.
Okay. And the third category operating in India are foreign banks.
Right. These are banks that are legally registered and have their headquarters in a foreign country, but they operate within India through branches or sometimes through wholly owned subsidiaries. The examples cited are HSBC, Citibank, Standard Chartered Bank.
So that covers the main segments within scheduled commercial banks. But the system isn't just about these large entities, right? There are other banking players with specific roles.
Absolutely. Moving beyond the, let's say, conventional commercial banks, we have institutions like the regional rural banks, or RRBs.
These were created back in the mid-1970s, specifically with rural areas in mind, weren't they?
Yes, exactly. Established under an ordinance in September 75, which later became the RRB Act of 1976, their core mandate was very clear: to ensure adequate institutional credit flow to agriculture and other crucial rural sectors.
And their operations are geographically restricted.
That's a key feature, yeah. Their area of operation is limited to specific districts, which are notified by the Government of India. They aren't meant to operate nationwide or even statewide in an unrestricted way.
How are they owned? It's a joint structure, I remember reading.
It is. Ownership is split three ways. The Government of India holds 50%, the concerned state government holds 15%, and specific sponsor banks hold the remaining 35%.
Sponsor banks.
Yeah, these are drawn from a list of 27 scheduled commercial banks and one state cooperative bank who kind of mentor or support the RRB.
Okay. Then we have the cooperative banks. These seem quite different in their whole philosophy.
They are quite different. A cooperative bank is a financial entity that's fundamentally owned and controlled by its members. The members are essentially both the owners and the customers.
So often formed by people from the same community or profession.
Exactly. They often spring up from groups sharing a common local area, maybe a professional background or some specific shared interest. They generally provide a range of banking services to their members.
But maybe more specialized.
Yes, the sources note they often specialize and might offer a more limited range of products compared to the big commercial banks, particularly focusing on agriculture-related financial products.
Which makes sense given their member-centric, often rural or community-based origins. They're described as primary financiers for agriculture, some small-scale industries, and self-employed workers.
Yes, playing a really crucial role in those specific segments. And they operate on a no-profit, no-loss principle, which is quite distinct from the commercial bank's profit motive.
Interesting.
The sources also give a historical nod to the Anyonya Cooperative Bank Limited in Vadodara, Gujarat, as the very first cooperative bank in India.
Now let's zoom back out and talk about those transformative reforms initiated after 1991 based on the Narasimhan Committee. How did they fundamentally reshape this structure we've just mapped out?
Oh, these weren't minor tweaks at all. They were really aimed at making the system much more competitive, more efficient, and better aligned with the needs of a liberalized economy.
A major change was the liberal entry of new players.
Absolutely. The reforms made it significantly easier for private sector banks and foreign banks to enter the Indian market.
And we see the impact of that today, clearly.
No doubt. As the sources highlight, this directly led to the establishment and growth of major private banks like ICICI, HDFC, and Axis, and it expanded the presence of foreign banks like Citibank, HSBC, and Barclays. All of this increased competition significantly for the dominant public sector banks.
Public sector banks themselves were also given greater autonomy.
Yes, they were granted more operational freedom. The idea was to let them respond better to the competitive environment, formulate their own strategies and policies within the overall regulatory umbrella of the RBI, of course.
A really significant reform was interest rate deregulation.
Huge. This was a massive shift from the previously controlled regime. Before the reforms, the RBI essentially set the interest rates that banks could offer on deposits and charge on loans.
But the reforms gave banks the freedom to decide these rates themselves.
Precisely. And this included rates on savings accounts, which had previously been centrally determined by the RBI. It really injected a competitive element into the pricing of financial products.
And the sources go into quite some detail about how this deregulation evolved the way banks set lending rates, starting with the benchmarked prime lending rate, or BPLR.
Yeah, under BPLR, banks had the freedom to set rates, but they were required to publish a rate that was supposed to be the minimum rate for their best, most creditworthy clients.
Supposed to be. But there was an issue with transparency and effectiveness, wasn't there?
Yes, the sources note that the BPLR system, quote, lacked transparency. Why? Because banks frequently lent below this published rate. It was called sub-BPLR lending, and this meant that when the RBI changed its policy rates, the impact wasn't always effectively transmitted to the actual lending rates people and businesses were paying in the market. It kind of diffused the signal.
Right. So to address that, the RBI introduced the base rate in 2010.
This was intended to be a much firmer floor. The minimum lending rate below which banks generally could not lend with only a few specific exceptions, like certain government-sponsored schemes or maybe loans against their own deposits.
What was the key improvement over BPLR then?
Well, the sources explain that the base rate actually incorporated a component for the bank's cost of funds plus a minimum marginal return. This made lending below it fundamentally unprofitable for the bank, so it became a much more meaningful floor for lending rates.
Got it. And the most recent evolution discussed is the marginal cost of funds-based lending rate, or MCLR.
Right. Introduced from April 1st, 2016, MCLR replaced the base rate system for all new rupee loans and also for renewals of existing credit limits. It's calculated based on the marginal cost of funds. Essentially, the cost the bank incurs to raise the next rupee of funding, the additional cost of arranging one more rupee to lend out.
So it's an internal benchmark determined by each bank?
Yes. The MCLR is designed to be more sensitive to changes in the bank's current funding costs and hopefully improve the transmission of RBI policy rate changes to actual bank lending rates.
And what about existing loans?
Existing loans linked to BPLR or base rate could continue until they were repaid or renewed, but borrowers were given the option to switch over to the MCLR system on mutually acceptable terms. And like base rate, MCLR also represents a minimum lending rate, again with some RBI-allowed exceptions.
Okay, that's a clear picture of how lending rates have evolved.
Right.
What were some other key reforms? Increased transparency was mentioned.
Yes, a big push for banks to fully disclose the state of their assets, both the good ones and the bad ones, the NPAs. More openness.
And the standardization of norms.
Bringing in uniform rules across the board for recognizing income, for classifying assets like loans, and for making provisions, setting aside funds for potential losses. This brought much-needed consistency across the entire banking sector.
And this led to that uniform definition for non-performing assets, NPAs we talked about.
Critically, yes. For the first time, the 90-day norm was universally applied. If interest or principal on a loan was overdue for 90 days, it had to be classified as an NPA. No more wiggle room. This removed ambiguity and forced banks to acknowledge bad loans much more promptly.
Finally, capital adequacy norms were introduced as part of these reforms.
Right. Banks were required to meet minimum capital levels relative to their risk exposure, basically aligning Indian banks with international best practices, the Basel norms.
Why is that so important? Why the focus on capital?
Because banking inherently involves risk. Lending money always means some borrowers won't be able to repay. Capital adequacy norms require banks to hold a minimum amount of their own funds, equity, reserves, not depositors' money, as a buffer.
A safety net.
Exactly. It acts as a safety net to absorb potential losses, protecting the interests of depositors and ultimately ensuring the stability of the financial system.
So, if we were to summarize the entire reform package, what was the big picture goal?
The overarching objective was really to foster greater competition. The idea was that competition would lead to better products, improved customer service, and more market-driven, finer-tuned interest rates. Ultimately, it was about creating a banking system capable of supporting the financial needs of a rapidly growing Indian economy and perhaps enabling bigger Indian banks to emerge as significant global players down the line.
Let's deepen our understanding of that capital adequacy piece, often referred to as the Basel norms. This is described as a critical element of global banking regulation.
It absolutely is. It stems from the recommendations of the Banking Committee for Financial Supervision, the BCFS, which is based in Basel, Switzerland, hence the name. It creates a global standard for how much capital banks should hold against their risks.
The analogy of requiring your own savings before taking on debt seems helpful here.
It captures the principle quite well. Banks, by their nature, take on significant risks, mainly through lending. Capital adequacy ensures they have a sufficient cushion from their own resources, their equity, their retained profits, to absorb potential losses before depositors' money is put at risk.
How is bank capital defined for these norms? It's not just one thing, is it?
No, it's typically categorized into tiers. Tier I capital, often called core capital, is the highest quality capital. This includes things like the bank's equity capital, its accumulated reserves, shareholders' funds, retained earnings essentially, money that is permanently available to absorb losses without triggering insolvency.
Okay, the core stuff. And Tier 2 capital, or supplementary capital.
This is considered less loss absorbent than Tier I, but still counts towards the overall capital requirements. It includes items like revaluation reserves on assets, though often taken at a conservative discount provisions set aside for standard, currently performing assets, and certain types of long-term debt, like subordinated debt.
And the sources are very careful to point out that deposits are not considered part of the bank's capital, right? That's public money they're holding as a liability.
Exactly. That's a crucial distinction. And there are also limits defined for Tier 2. It couldn't exceed 100% of Tier I capital, and the subordinated debt component within Tier 2 couldn't be more than 50% of Tier 1, just to maintain the quality of the capital base.
So how is the amount of capital required actually determined? It's not a fixed sum.
No, it's relative to risk. It's determined by looking at the bank's risk-weighted assets, or RWAs. This is where the central bank assigns a risk weight to different types of bank assets based on their perceived riskiness.
Can you give an example?
Sure. A loan to the government might have a very low or even zero risk weight because it's considered very safe, whereas a loan to a startup or a highly leveraged company might carry a much higher risk weight, maybe 100% or more. The total RWAs represent the bank's overall risk exposure, weighted by the risk of each asset.
And Basel I norms set the initial benchmark for the ratio.
Yes, they required a minimum capital adequacy ratio, or AIR, of 8%. This means a bank's total capital, Tier I plus Tier 2 combined, had to be at least 8% of its total risk-weighted assets.
So using your example, for every 100 of risk-weighted exposure on its books, the bank needed to hold at least €8 in qualifying capital.
Precisely.
And India implemented this.
Yes, the RBI set a time frame for Indian banks to become Basel I compliant. And interestingly, the norm was subsequently raised in India to 9%, which was the requirement at the time the source material was written, and according to the text, continued to be the standard in India.
Okay. Then came Basel II norms, which refined the framework further.
They did. They introduced more sophisticated methods for measuring credit risk, allowing banks to potentially use their own internal models under certain conditions. And importantly, they added explicit capital requirements for operational risk.
Operational risk, what's that?
That's the risk of losses resulting from things like inadequate or failed internal processes, errors made by people, system failures, or external events like fraud or natural disasters. Basel, I primarily focused on credit risk borrowers not repaying and market risk from trading activities. Basel II broadened the scope significantly by adding operational risk.
Did the ratio change?
The minimum global CRA remained 8% under Basel II, but as mentioned, India maintained its higher requirement of 9%.
And were Indian banks compliant with both Basel II?
Yes, the sources confirmed that all Indian banks achieved compliance with both Basel I and Basel II norms.
The sources also mentioned that after the global financial crisis of 2007-08, the capital requirements were further increased.
Right. This is referencing the move towards Basel III. The crisis exposed weaknesses even in the Basel II framework. So Basel III was designed to make banks even more resilient, demanding not just more capital, but also higher quality capital, more emphasis on Tier I equity, and introducing new liquidity requirements as well.
Why the constant tightening?
The reasoning was straightforward. Bolster banks' capacity to withstand severe economic and financial shocks, learn the lessons from the crisis, and reduce the likelihood of future taxpayer bailouts.
This has helped standardize financial regulation globally, hasn't it?
To a large extent, yes. And that standardization provides valuable information. Investors, depositors, regulators can look at a bank's reported capital adequacy levels, how much buffer they have relative to their risks under these internationally agreed norms, to get a better sense of its fundamental strength and make more informed decisions.
Shifting from capital strength to the active flow of money, let's talk about liquidity management. This is described as a critical function of the RBI, and the sources highlight a direct link between banking liquidity and inflation.
Absolutely. This is fundamental monetary policy. Banks' ability to lend money essentially injects more spending power into the economy. If there's too much money chasing too few goods and services, you get upward pressure on prices inflation.
So banking liquidity is essentially the money that banks can potentially lend out.
Yes. And through a process known as credit creation, banks can actually lend out multiples of the initial deposits they receive. The sources describe this as injecting almost like fresh money into the system. This fuels demand and can certainly contribute to inflationary pressures if not managed carefully.
Which means liquidity management by the RBI is a very tricky balancing act.
It absolutely is. The RBI has to ensure there's enough liquidity in the system to keep the wheels of the economy turning, for businesses to invest, for consumers to spend, supporting growth. But not so much liquidity that it overheats the economy and leads to undesirable levels of inflation. Striking that balance is one of its most important ongoing responsibilities.
In addition to all its other roles, Apex Bank, banker to the government, banker to banks, etc.,
Right, and the primary source of this liquidity for banks, it comes from their deposits.
which are broadly categorized as demand deposits and time deposits.
Exactly. Demand deposits are funds payable whenever the customer demands them, like money in savings or current accounts. Time deposits are funds locked in for a fixed period, like fixed deposits, FDs. Both types collectively form the bank's demand and time liabilities, or DTL. An increase in these liabilities is what increases the potential liquidity available for banks to use.
And the challenge for the RBI is they can't just, stop people from depositing money or arbitrarily tell banks to stop lending altogether.
No, banks need those deposits to fund their loans, and they need to lend to earn profits and pay interest back to the depositors. So the RBI manages liquidity not by stopping these core activities, but by using specific tools to influence the amount of lendable funds circulating in the banking system at any given time.
Okay, let's look at some of those tools, starting with the quantitative ones, the ones involving specific ratios or amounts.
First up is the cash reserve ratio, or CRR. This is a certain percentage of a bank's net demand and time liabilities, NDTL, which is a slightly refined measure of DTL, that they must hold as cash directly with the RBI. They don't earn interest on this cash.
It's a mandatory non-earning reserve. How does the RBI use it to manage liquidity?
It's quite direct. If the RBI wants to drain excess liquidity from the system, maybe because inflation is picking up, it raises the CRR. Banks then have to transfer more cash to their accounts with the RBI, which reduces the amount of money they have available to lend out.
And the reverse.
If the RBI wants to inject liquidity into the system, maybe to stimulate growth, it lowers the CRR. This releases cash back to the banks, increasing their capacity to lend.
The sources give a pretty vivid illustration of just how powerful this tool can be.
They do. They calculate that on a public deposit base exceeding, 50 lakh crore, a mere 1% increase in CRR takes a massive 50,000 crore out of the banking system and parks it with the RBI effectively overnight.
Wow.
Even a smaller hike, say 0.25%, removes 12,500 crore.
That's a huge amount of potential lending just pulled out of the economy almost instantly.
It really shows how potent the tool is. Such significant sums being removed from circulation can certainly put a brake on lending, potentially slowing down industrial activity, or even contributing to an economic slowdown if it's not used very judiciously.
Which is why the sources add a note of caution about its usage, right?
Exactly. CRR is powerful, a bit of a blunt instrument perhaps, and should be used carefully. The RBI needs to consider the broader economic picture, not just focus narrowly on inflation control. Frequent, sharp increases in CRR can create uncertainty for banks trying to make long-term lending decisions. So it's generally seen as a tool best reserved for exceptional circumstances or when there are significant adverse economic shifts happening.
Yeah.
The CRR rate mentioned in the source as of December 2017 was 4.00%.
Okay. Next quantitative tool is the statutory liquidity ratio, or SLR.
Right. Besides CRR, banks must also set aside a certain percentage of their NDTL in specified liquid assets. These eligible assets include cash held with the RBI, gold held with the RBI, or, most commonly, investments in approved government securities, GSECs.
And banks usually prefer the government securities route.
Yes, generally, because unlike the cash held under CRR, those government securities earn them interest income. The minimum SLR requirement cited in the source, effective August 2017, was that 20% of NDTL had to be held in these forms.
Is SLR as actively used for day-to-day liquidity management as CRR might be?
The sources suggest it's currently less effective as a flexible, short-term liquidity management tool. Why? Because banks often hold more government securities than the minimum SLR requirement anyway, perhaps for safety or other portfolio reasons.
So changing the minimum rate might not immediately free up or lock away significant additional funds if they're already holding excess GSECs.
Precisely. It makes SLR changes less impactful for fine-tuning short-term liquidity compared to other tools.
Then there's the historical tool, the bank rate.
This is the interest rate at which the RBI lends money to commercial banks, usually longer term, against eligible securities without a specific repurchase agreement attached. Historically, back in the more controlled era, it was a key policy rate. Raising the bank rate made borrowing from the RBI more expensive, discouraging it and thus reducing liquidity. It also served as a benchmark for other interest rates in the system.
But its primary role has changed significantly.
Yes. With the development of a vibrant secondary market for government securities and the introduction of more targeted liquidity management tools like repo operations, the bank rate is no longer the primary instrument for signaling monetary policy stance or managing day-to-day liquidity. The sources state it still exists, but its main function now is primarily as a penalty rate, charged when banks default on their CRR or SLR requirements, for example.
Okay. What about open market operations, or FOMOs? These involve the RBI actively buying or selling government securities in the open market.
Correct, usually conducted through auctions. Unlike CRR or SLR, this isn't a mandatory ratio imposed on banks. It's a market-based operation initiated by the RBI.
How does it affect liquidity?
It's straightforward. When the RBI sells government securities, banks or other market participants buy them, and money flows from the banking system to the RBI. This effectively drains liquidity. Conversely, when the RBI purchases securities from the market, it injects money into the banking system, increasing the liquidity available for lending.
And these are done regularly.
Yes, the sources mentioned they are typically performed at quarterly intervals, used for managing liquidity over a slightly longer horizon than, say, daily fluctuations.
Now, for managing that very short-term, often overnight liquidity, the most frequently used tool seems to be the repo auction.
Absolutely. Repo, which stands for repurchase obligation, is a mechanism for banks to borrow funds from the RBI for very short durations, often just overnight.
How does it work?
Banks pledge eligible government securities. Importantly, these must be securities held above their mandatory SLR requirement with the RBI and receive funds in return. There's a simultaneous agreement to repurchase those exact securities back from the RBI at a slightly higher price on a specified future date, usually the next day.
And the interest rate implied in that price difference is the repo rate.
Exactly. The repo rate is effectively the interest rate banks pay for the short-term borrowing from the RBI. The sources note the repo rate was 6.0% effective from September 2017.
And reverse repo is the mirror image.
Pretty much. That's when the RBI borrows money from the banks. Banks with excess short-term liquidity can lend it to the RBI, again, often overnight. They do this by purchasing government securities from the RBI with an agreement for the RBI to repurchase them the next day at a slightly higher price.
So banks are parking their surplus funds with the RBI temporarily and earning interest.
Yes, and the interest rate the RBI pays to the banks for these funds is the reverse repo rate. The source gives this rate as 5.75% effective from September 2017.
And you mentioned the repo rate is always higher than the reverse repo rate.
Yes, the sources point that out. And at the time of writing, they were typically linked by a fixed spread, mentioned as 25 basis points, 0.25%. This creates a corridor for short-term interest rates.
Is there also a facility for real emergency liquidity needs when things get tight?
Yes, there is. That's the Marginal Standing Facility, or MSF. It was introduced in 2011 as part of the broader Liquidity Adjustment Facility, LAF. Think of it as a safety valve, an emergency window for banks to borrow directly from the RBI when interbank liquidity, the banking. The market where banks lend to each other has completely dried up, maybe due to unexpected stress.
And the rate for using this MSF window is higher, presumably.
Yes, significantly higher. It's pegged 100 basis points, or 1%, above the prevailing repo rate. This penal rate ensures banks use it only as a last resort. Banks can borrow up to a certain limit, mentioned as 1% of their net demand and time liabilities (NDTL), under this facility, giving them access to funds where no other short-term options are available.
Finally, among the tools, there's a non-quantitative one mentioned: moral suasion.
Right. This isn't about setting ratios or interest rates. It's about the central bank using its authority, its influence, its powers of persuasion to convince commercial banks to act in a certain way, perhaps to lend more to specific sectors or be more cautious during certain periods in line with the broader economic interests of the country and the RBI's stated monetary policy goals. It's more about guidance, communication, and persuasion than hard rules.
The sources seem to offer a kind of framework for which tool is best suited for different types of liquidity situations.
They do suggest a hierarchy, somewhat. Short-term or highly volatile fluctuations in liquidity are best handled by quick, frequent operations like the repo and reverse repo auctions. Medium-term liquidity management might be better addressed using VOMOs, while more structural or longer-term liquidity imbalances could potentially warrant adjustments in the CRR.
And the RBI actively uses and adjusts these tools during its regular monetary policy reviews.
Yes, absolutely. As part of its annual monetary policy cycle, which is reviewed quarterly, the RBI assesses the prevailing liquidity situation, looks at inflationary pressures, considers the economic growth outlook, and then decides whether to adjust CRR, SLR, the repo reverse repo rates, or perhaps announce the schedule for FOMOS. Their role as the banker to all commercial banks also gives them direct insights and the channels needed to implement these measures effectively.
Now, beyond managing the system's overall stability and liquidity, the RBI also has the strong mandate for mass banking and ensuring credit reaches specific segments of the economy. This is where directed lending or priority sector lending comes in.
This is a really crucial and somewhat unique aspect of the Indian banking system. It reflects policy objectives that go beyond pure commercial profitability for the banks. The RBI essentially requires banks to allocate a certain defined portion of their total lending to sectors that are considered vital for inclusive growth and for supporting weaker sections of society.
And the RBI actually provides the specific categories that fall under this priority sector lending umbrella.
Yes, the sources list the main ones quite clearly. Agriculture is a big one, obviously. Then you have micro, small and medium enterprises, or MSMEs, export credit, education loans, housing loans up to certain limits, social infrastructure, renewable energy projects, and finally, a residual category just called others.
What kind of specific lending activities would fall under these categories?
Well, the examples provided include things like loans given directly to farmers for cultivation or financing self-help groups, SHGs, which are often involved in rural livelihoods. It could also be financing institutions that support agriculture, like those providing inputs or storage. Providing credit to small factories or workshops would fall under MSMEs. Educational loans for students, or housing loans within the specified financial limits for building or buying a home.
And banks have very specific targets they must meet for this lending, don't they? It's not just a suggestion.
Oh no, it's mandatory. For most domestic scheduled commercial banks, and also for foreign banks that have a significant presence in India, defined as 20 or more branches, the overall target is quite substantial. It's 40% of their adjusted net bank credit, ANBC, or an equivalent measure of their off-balance sheet exposure, whichever is higher.
40% is a big chunk. And are there sub-targets within that 40%?
Yes, absolutely. For the domestic banks and the larger foreign banks, within that 40% overall target, there are specific minimums for certain sectors. 18% of ANBC must go towards agriculture.
Okay.
And within that 18% for agriculture, there's a further sub-target. 8% of ANBC must be specifically directed towards small and marginal farmers, ensuring the smallest landholders get access.
Right.
There's also a target of 7.5% of ANBC for microenterprises, the smallest businesses, and another 10% of ANBC targeted specifically for advances to weaker sections.
What about foreign banks with a smaller presence, say less than 20 branches? Do they have the same target structure?
They also had a 40% overall target for total priority sector lending, but the sources indicate this was something they needed to achieve in a phased manner, reaching the target by 2020. Importantly, the sources state that these smaller foreign banks were explicitly not subject to those specific sub-targets for agriculture, microenterprises, or weaker sections. Their requirement was just the overall 40%.
The sources also provide some specific monetary thresholds for certain types of loans to qualify under priority sector.
They do. For education loans, for example, loans given to individuals up to 10 lakhs for studies within India and up to 20 lakhs for studies abroad would count towards meeting the bank's priority sector target.
And for housing loans?
There are limits based on the location and size of the loan. Up to 25 lakhs in the larger metropolitan centers, defined as population over 10 lakhs, and up to 15 lakhs in other centers, specifically for the purchase or construction of one dwelling unit per family. Interestingly, it explicitly excludes loans given to the bank's own employees.
Got it. And the definition of weaker sections for these priority sector loans is quite detailed, covering a range of vulnerable groups.
It is very specific. It includes small and marginal farmers, artisans, village and cottage industries, where individual credit limits are below 50,000 euros, beneficiaries of specific government poverty alleviation and employment generation schemes like SGSY, now NRLM, DRS, SGSRY, SRMS, members of scheduled castes and scheduled tribes.
It also includes loans to self-help groups.
Yes, loans to SHGs are included. Also, loans given to distressed farmers who are indebted to non-institutional lenders, like local money lenders, and loans to other distressed persons, not farmers, up to $50,000 per borrower, specifically to help them repay debt owed to non-institutional lenders. And finally, loans to individual women beneficiaries up to $50,000 per borrower.
So that 40% overall target isn't just a broad number. It's carefully structured with sub-targets and definitions to ensure credit really flows to very specific, often underserved segments of the population.
It's fundamentally a regulatory mechanism. It's designed to ensure that even in a competitive, commercially driven environment, banks contribute directly to broader social and economic development goals by providing credit to areas and groups that might otherwise be neglected by the formal financial system if lending decisions were based purely on risk and return calculations alone.
So what happens if a bank fails to meet these priority sector targets, particularly the crucial sub-target for agriculture? Is there a penalty?
Yes, there's a consequence. That's where the Rural Infrastructure Development Fund, or RIDF, comes into play. Banks that fall short of their mandatory priority sector lending target for agriculture are required to contribute the amount of that shortfall to this specific fund, the RIDF.
This fund was set up by the government quite a while back in the mid-90s.
Yes, exactly, during the 1995-1996 period. Its specific purpose was to provide funding for ongoing rural infrastructure projects across the country. The fund itself is managed and maintained by NABARD, the National Bank for Agriculture and Rural Development.
And NABARD uses these contributions from the banks that miss their targets.
Precisely. It provides loans from this RIDF corpus primarily to state governments and state-owned corporations. The objective is to help them accelerate the completion of various rural infrastructure projects that might otherwise be delayed or stalled due to funding constraints at the state level.
The scope of what RIDF finances seems to have expanded significantly over time, based on the sources.
It really has. The sources list a very wide array of eligible activities, especially from the fifth tranche, RIDF-V, onwards. It goes well beyond just traditional projects like irrigation canals or rural roads.
What else is included?
Things like rural drinking water schemes, soil conservation projects, building rural market yards, setting up rural health centers and primary schools, even financing mini hydel power plants, Shishu Shiksha Kendras, child education centers, Anganwadis, child care centers, and projects aimed at improving the power distribution system in rural areas.
So it's a really broad definition of rural infrastructure.
It is. The list also explicitly includes projects undertaken by local government bodies, the Panchayat Raj institutions, and various social sector projects focusing on primary education, health, and drinking water. And there's more.
Go on.
Minor and micro irrigation, flood protection works, watershed development programs, drainage improvement, forest development, various types of market infrastructure like go-downs, warehouses, apna mandis, farmer markets, rural hot local markets, cold storage facilities, different kinds of farms, seed, agriculture, horticulture, plantation and horticulture activities, facilities for grading and certifying produce, like testing labs, community irrigation wells for shared use, fisheries development, animal husbandry projects, and even modern abattoirs. It's designed to address a really wide spectrum of infrastructure needs that are considered essential for boosting rural growth, productivity, and quality of life.
Okay, let's pivot back to the public sector banks, PSBs, traditional backbone of the system. The sources note their continued dominance in terms of overall market share, but also point out that private banks are steadily eroding this dominance.
Yeah, it's definitely a changing landscape. While PSBs still hold a very significant share of the banking business, maybe around 70% according to the source context, their share is gradually declining relative to the faster growth being achieved by the private sector players.
And the sources are quite direct, maybe even critical, in highlighting some perceived weaknesses or challenges associated with the PSBs.
They are. For instance, they note that while PSBs are certainly involved in financing large infrastructure projects, their capability for undertaking very large-scale, complex infrastructure lending, which includes robust risk assessment and sophisticated mitigation strategies, is perhaps yet to be tested on the massive scale that might be required for India's future growth ambitions.
Internal issues are also flagged quite clearly.
Yes, the material mentions concerns about things like excessive manpower in some areas, an aging workforce profile overall, and a perceived difficulty in truly assimilating technology deep into their operations and work culture, rather than just adopting new systems superficially.
And their approach to risk.
They are often characterized, according to the sources, as being fairly risk-averse and having an overwhelming security consciousness. Now, while prudence is good in banking, this can sometimes hinder agility, innovation, and responsiveness in a competitive market. The sources also suggest that despite the priority sector mandates and many well-intentioned government schemes routed through them, PSBs haven't always been as effective as perhaps hoped in truly reaching the neediest segments, like the small-scale industrial sector.
What about on the critical mission of financial inclusion that we discussed earlier? How do the sources rate the PSB's performance there?
Well, the assessment presented in the material is quite blunt, actually. It says their efforts have been far from satisfactory.
Ouch. And a key reason cited for this is the mindset.
Yes, the sources suggest that financial inclusion is often still viewed within PSBs primarily as a social obligation, a kind of socio-welfare measure, rather than being seen as a commercially viable business opportunity in its own right.
That difference in perspective is seen as a significant barrier to driving inclusion effectively and innovatively.
Exactly. Structurally, the sources also comment that simply having too many nationalized banks of varying sizes might actually hinder organized growth and can lead to inefficient competition among themselves, rather than purely against private players.
Interestingly, though, the sources offer a somewhat positive take, or at least the nuanced one, on the PSB's role during the 2007-08 global financial crisis.
Yes, it suggested that India's banking sector weathered that storm relatively well, partly because of the public sector character of the dominant banks. PSBs generally had less exposure to the complex, highly risky financial products that were at the heart of the crisis in the West. Their approach was broadly seen as more traditional and prudent.
But the counterpoint presented is that this very same character, the prudence, the bureaucracy perhaps, has potentially held them back from the kind of aggressive expansion and innovation seen in some private sector banks.
Yes, that trade-off between stability and dynamic growth is definitely highlighted. And it's pointed out that on a global scale, despite India being one of the world's major economies, none of the Indian public sector banks actually rank among the top 50 banks globally by size or reach.
Which really underscores the need for them to become much larger and stronger to support the economy's ambitions.
Absolutely. To effectively serve as the financial backbone for a rapidly growing and globalizing economy like India's, they need greater scale, more efficiency, and enhanced strength. The sources explicitly suggest that consolidation, meaning merging some of these banks to create fewer, larger, more robust entities, is a necessary path forward.
And they also need to address that risk aversion.
Yes, the sources suggest they need to shed some of that excessive risk averseness. Now, that doesn't mean becoming reckless, obviously. It means being willing to take judicious, well-assessed, calculated risks that are essential for supporting economic growth, financing innovation, and competing effectively.
Privatization is mentioned as a possibility, though maybe premature at the time the source was written.
The sources definitely consider it. They state that while it might not be immediately on the cards, it could become an imperative in future. The argument presented is that, eventually, privatization could be in the best interest of both the PSBs themselves, by freeing them from certain constraints, and the wider economy. The idea is it could potentially enable them to innovate more freely, meet the diverse financial demands of a growing economy more effectively, and maybe eventually emerge as truly global banking players.
But throughout all this, the RBI's role in regulation and oversight is seen as absolutely key, regardless of ownership.
Yes, definitely. Regardless of whether banks are public or private, a strong, vigilant regulatory framework and effective oversight mechanism are paramount for stability. And the sources actually offer praise here, commenting that in this regard, the RBI has generally scored over all the other central banks globally.
So the key challenges for PSBs, and indeed the sector overall, seem to boil down to achieving rapid and deep banking penetration across the entire country, nurturing some Indian banks to grow to global scale and significance, and effectively meeting the diverse and growing financial needs of the economy, especially their crucial role in infrastructure development and financial inclusion.
Because, as the sources emphasize repeatedly, banking is truly the fulcrum of an economy. Its strength, its efficiency, its reach are fundamental enablers of rapid economic growth and ensuring that financial resources flow smoothly to where they can be most productive.
That emphasis on reaching everyone brings us squarely back to financial inclusion. The sources highlight the sheer scale of the problem. At the time of writing, a significant portion, potentially as much as 60% of India's population, was still effectively outside the reach of the formal banking system.
60%. That's a massive number of people, and small businesses too, who lack access to even basic, formal financial services.
And financial inclusion is defined broadly as the effort to provide banking products and services to these masses, especially the poor, ideally in a technology-enabled way and at affordable prices.
Now, there's a perspective mentioned that public sector banks are uniquely positioned, or perhaps uniquely obligated, to drive financial inclusion, especially if you view it primarily as a socio-welfare measure. This ties into the existing concepts like priority sector lending, perhaps at concessional rates for disadvantaged groups. In this view, directed lending becomes less about strategic business and maybe more about fulfilling a regulatory compulsion.
But the sources present a strong counter-argument to that view, don't they?
They do. They argue quite forcefully that financial inclusion should absolutely be seen and pursued as a commercial and viable business opportunity, not just as a welfare activity or a burden.
Why frame it that way? What's the logic?
Well, they point to the very high opportunity cost faced by poor individuals or small businesses, when their only option is to borrow from informal moneylenders, often at exorbitant, crippling interest rates. The argument is that this huge underserved segment, viewed collectively, actually represents a large, potentially profitable market for banks if they can find the right way to serve them.
And private banks, being driven by profitability,
Are seen as having the inherent motivation to find ways to serve all segments, including lower income ones, if they can make it commercially viable. The profit motive can be a powerful driver of innovation in reaching new markets.
so the core challenge isn't necessarily the willingness to serve, but finding cost-effective ways for the formal financial system to actually reach these vast populations and provide them with services that are genuinely better alternatives to the informal lenders.
Precisely. Opening traditional brick-and-mortar bank branches in every single village across India might simply not be economically feasible or sustainable. So innovation in delivery models is absolutely required. The sources even suggest that the private sector, with its inherent focus on efficiency and finding new market opportunities, might actually be better equipped to discover and implement these cost-effective solutions than traditional PSBs might be, given their structures and legacy systems.
And technology is seen as a crucial enabler in all of this.
Absolutely critical. The sources highlight how deeply technology, especially mobile technology, has penetrated across India, reaching virtually every segment, every walk of life. They pose the question, why can't technology be leveraged more effectively to reach the poor with financial services?
They use the example of mobile phones themselves.
Yes, mobile phones were once considered a luxury item for the affluent, but now they've penetrated all classes. This is presented as proof of business ingenuity, driven by the profit motive, in tapping opportunities across all income levels when the right product and delivery model are found.
The comprehensive definition of financial inclusion provided in the sources goes beyond just opening a basic bank account, doesn't it?
It really does. It emphasizes that individuals and businesses need not just access to, but also the ability to effectively use a broad range of financial services. These services must be provided responsibly at a reasonable cost by institutions that are themselves financially sustainable and all within a well-regulated environment. It's about the combination of availability, usability, affordability, and trust.
And there have been numerous government and RBI initiatives specifically designed to push this financial inclusion agenda forward over the years.
Yes, the sources list several key ones. The Self-Help Group Bank Linkage Program, SHGBLP, which connects informal women's groups to formal credit. The big push for opening no-frills accounts, now often called Basic Savings Bank Deposit Accounts, BSBDAs, which have low or zero minimum balance requirements. The promotion of mobile banking and agent banking, business correspondence. The introduction of Kisan credit cards, KCC, specifically for farmers' credit needs. And, of course, the massive Pradhan Mantri Jan Yojana, PMJDY, launched with the ambitious goal of providing every household in India with access to a bank account and basic financial services.
So the key message about how to actually achieve deep and meaningful financial inclusion seems to be a combination of leveraging technology effectively and, perhaps crucially, viewing it fundamentally as a legitimate business proposition, not merely a welfare measure.
That shift in perspective is seen as key. Linking the poor and underserved to the formal banking system is described as a major national imperative, serving multiple interconnected objectives simultaneously.
For the individuals, it gives them access to organized, regulated sources of finance, potentially freeing them from the clutches of high-cost, informal debt.
Yes, and from the government's perspective, it provides a robust mechanism for delivering income support or subsidies directly into people's accounts, which can be much more efficient and transparent than traditional subsidy methods and helps eliminate middlemen in the process.
Ultimately, financial inclusion is seen as absolutely integral to achieving India's future inclusive growth. It's not an optional add-on.
Exactly. The benefits detailed are significant. It enables people to make better financial decisions through improved financial literacy and access to qualified advice. It provides access to essential financial services for vulnerable groups, weaker sections, minorities, migrants, the elderly, micro-entrepreneurs, low-income households at an affordable cost.
And empowers them in practical ways.
Yes, empowers them to manage their day-to-day finances more confidently, effectively, and securely. It helps them plan for the future, Things like protecting against income fluctuations, building wealth over time, and benefiting from developments in the broader financial sector. And critically, it helps them deal with financial distress much more effectively, reducing their vulnerability to unexpected shocks like illness or crop failure.
The UNCDF perspective mentioned reinforces this idea of it being a business opportunity.
Yes, viewing financial services for poor, low-income groups and MSMEs not just as a development issue, but as an important integral component of the overall financial sector, with each segment representing a potential business opportunity for providers who can serve them effectively. But despite all the progress from these various initiatives, the sources acknowledge that the problem of financial exclusion still persists significantly. Therefore, maintaining a strong focus on financial inclusion is seen as essential, even a prerequisite, for achieving truly inclusive growth across the nation. And achieving credit inclusion, ensuring that disadvantaged and vulnerable groups have access to formal credit when they need it, is highlighted as perhaps the crucial first step towards achieving comprehensive financial inclusion.
To specifically target some of these underserved segments and further promote inclusion, the RBI has also licensed new categories of banks, known as differentiated banks, namely small finance banks and payments banks.
Right. These are newer types of banking licenses that come with specific, often narrower mandates compared to universal commercial banks. They're designed primarily to serve specific niches in the market, particularly those related to bolstering financial inclusion efforts.
Okay, let's start with small finance banks, or SFBs. What's their role?
These are set up as private financial institutions. Their primary stated objective is to further financial inclusion.
And what are their core banking activities?
They perform the basic essential functions of banking. They can accept deposits from the public, and they can undertake lending activities.
And who are their main target customers?
The material is quite specific here. Unserved and underserved sections of the population. This includes small business units, small and marginal farmers, micro and small industries, and various entities operating in the unorganized sector. Precisely those segments often overlooked or found difficult to serve profitably by the larger commercial banks.
Unlike the regional rural banks, RRBs, we discussed earlier, SFBs don't have geographical restrictions on their area operations.
That's a key difference mentioned, yes. An SFB, once licensed, can operate anywhere in India, provided they meet the specific licensing conditions and ongoing regulatory requirements set by the RBI. They aren't confined to specific districts like RRBs are.
Their creation was announced in the union budget back in 2014-15.
That's right, July 10th, 2014. The RBI then issued detailed operational guidelines in November 2014. And to really kickstart this initiative and give a boost to financial inclusion, the RBI granted in-principle approval to 10 applicants in September 2015. These were selected from a much larger pool of 72 applicants.
Did the sources list those 10 entities that got the initial nod?
Yes, they do. O Financiers, Capital Local Area Bank, Disha Microfin Equitas Holdings, ESAF Microfinance and Investments, Janalakshmi Financial Services, RGVN Northeast, Microfinance, Surya Microfinance, Ujjivan Financial Services, and Utkarsh Microfinance.
The crucial point that distinguishes them from the other type of differentiated bank is that SFBs can take deposits and they can lend money.
Exactly. That capability to undertake lending is what differentiates them fundamentally from payments banks. And it's worth noting that many of the entities that received these SFB licenses were already operating successfully as microfinance institutions, MFIs.
Ah, so they already had a customer base in the target segments.
Precisely. Their existing customer base, MSMEs, small businesses, low-income households, was already well aligned with the intended focus of SFBs. This transition essentially allowed these entities to bring their existing clients and new ones more fully into the formal banking system by offering them a wider range of products, including savings accounts and properly regulated secured loans, not just the group lending often associated with MFIs.
So SFBs represent another strategic step, another tool in the kit, to provide tailored, affordable banking products specifically designed for those unserved and underserved sections, bringing them more firmly into the formal financial system.
Right. Now, payments banks are different again, quite distinct.
They are also classified as differentiated banks, but they operate under quite significant restrictions on their functions, as allowed by the Banking Regulation Act, 1949.
That's the key word, restricted functions. What are they allowed to do? Well, they can accept deposits, primarily demand deposits, though initially there was a limit imposed up to 1 lakh per individual customer. Their main focus is on providing payments and remittance services, facilitating money transfers.
What else?
They can offer internet banking. They can function as business correspondents, BCs, for other larger banks, helping extend reach. They can also sell simple third-party financial products like insurance policies or mutual fund units. And they can issue ATM or debit cards linked to the accounts they hold.
But the restrictions are very important to understand. What can they not do?
This is crucial. Payments banks are expressly not allowed to undertake any lending activities at all. This is their most significant limitation compared to SFBs or universal banks. They cannot issue credit cards. And they're also prohibited from setting up subsidiaries to undertake non-banking financial services activities. Their scope is deliberately narrow, focused on payments and deposits.
The licensing process for payments banks also involved an external advisory committee headed by Dr. Nachikit Moore.
Yes. RBI released the list of 41 applicants way back in February 2015. The committee, chaired by Dr. Moore, evaluated these applications based on criteria like financial track record and governance structures. It was also mentioned that India Post, the government's postal department, intended to leverage its vast physical network to set up its payments bank.
What were the main objectives behind creating this specific category of payments banks?
Very similar goals to SFBs, fundamentally. Bring the huge number of unbanked and underbanked masses into the formal banking system, expedite financial inclusion, enhance financial literacy among the poor, and generally contribute to poverty reduction efforts. It was seen as a significant, innovative step by the RBI to try and reach people, especially in remote rural areas who are outside the banking net.
How else were they expected to help?
By ensuring more money enters the formal banking system rather than circulating as cash. They were also envisioned as playing a key role in helping the big commercial banks, like SBI for instance, increase their own rural reach cost-effectively by using these payments banks as their business correspondents in far-flung areas. And indeed, some big banks did tie up with licensed payments banks for this purpose.
The sources list the entities that received the in-principle licenses for payments banks initially?
Yes, the list included Aditya Birla Nuvo, Airtel M-Commerce Services, Cholamandalam Distribution Services, the Department of Posts, Fino Paytech, National Securities Depository Limited, NSDL, Reliance Industries, Dilip Shangvi, representing Sun Pharmaceuticals, Vijay Shekhar Sharma, representing Paytm, Tech Mahindra, and Vodafone M-Pesa.
And it's noted that some of these initial licenses were later surrendered before launch.
That's correct. The sources mentioned that 3 entities, Cholamandalam Distribution Services, Dilip Shangvi, and Tech Mahindra, eventually decided not to proceed and surrendered their in-principle licenses.
What does that in-principle stage actually mean in the licensing process?
It means the RBI has given a preliminary approval, but the entity isn't a bank yet. The in-principle license is typically valid for about 18 months. During this period, the applicant needs to fulfill all the stringent requirements set out by the RBI, setting up the technology, processes, governance structures, hiring staff, etc. Importantly, they are not allowed to conduct any banking activities during this 18-month period. The full final banking license under Section 22 of the Banking Regulation Act 1949 is granted by the RBI only after it is satisfied that all the conditions have been met.
How are payments banks regulated once they're operational?
They are required to be registered as public limited companies under the Companies Act 2013. They are licensed under the Banking Regulation Act 1949, but with specific conditions tailored to their limited functions. They are governed by a range of legislation including the Banking Regulation Act, the RBI Act, the Foreign Exchange Management Act, FEMA, the Payment and Settlement Systems Act 2007, and various guidelines issued by regulators like the RBI and SEBI, especially if they become listed companies.
Did the entry of these new differentiated banks cause any reaction from the established big banks?
The sources mention that their arrival did cause some jitters among the major commercial banks, understandably perhaps. However, they also note the potential upside for the big banks. They could strategically leverage these payments banks with their potentially lower cost structures and focus on reach as business correspondents to extend their own services into previously unviable areas. So turning a potential competitor into a channel partner.
Okay, let's discuss a concept that gained prominence globally, especially after the financial crisis, and is now applied domestically in India. Domestic Systematically Important Banks, or DSIBs. The sources mention HDFC Bank being identified as a DSIB at the time of writing.
Right. DSIBs are essentially banks that are considered too big to fail, often abbreviated as TBTF.
Why that rather dramatic name, too big to fail?
It's because of their characteristics. Their sheer size, Often their cross-jurisdictional activities, the complexity of their operations, a potential lack of easy substitutes for the services they provide, and their high degree of interconnection with the rest of the financial system. The failure of one of these banks wouldn't just impact its own customers and shareholders. It could trigger a dangerous cascading effect, potentially destabilizing the entire national economy.
So their failure could have seriously disruptive consequences for the whole system. How does the RBI identify which banks fall into this category?
The primary quantitative indicator mentioned is size. Banks whose total assets cross a certain threshold, specifically cited as 2% of the country's gross domestic product, GDP, are considered potential DSIBs and are then subject to further qualitative assessment by the RBI.
And once a bank is formally identified as a DSIB, it faces additional stricter regulation.
Yes, that's the core idea. They are placed into different buckets based on their assessed level of systemic importance. Banks classified in higher buckets, meaning they are deemed more systemically important, face stricter regulatory requirements. Most notably, they are required to set aside additional common equity Tier 1 capital, the highest quality capital as a percentage of their risk-weighted assets, RWAs.
An extra capital buffer just for them.
Exactly. This extra capital buffer is mandated specifically because of the greater risk their potential failure poses to the system. It makes them more resilient.
Are they also monitored more closely?
Yes, DSIBs are subject to closer monitoring and more intense supervision by the central bank. This is to ensure their operations remain sound, their risk management is robust, and to potentially prevent their involvement in excessively risky or gray area activities like money laundering. This identification and heightened supervision happens both domestically by central banks like the RBI and globally by bodies like the Basel Committee on Banking Supervision for Globally Systemic Banks, GSIBs.
Shifting gears now to a completely different kind of asset, gold. The sources discuss two specific union government schemes launched back on November 5th, 2015, both related to gold.
Yes, these were the Sovereign Gold Bonds, SGBs, and the Gold Monetization Scheme, GMS. Both were aimed at leveraging India's enormous household gold holdings in different ways.
What were the main overarching objectives behind launching these two schemes?
The core idea really was twofold. First, to reduce the physical demand for gold within the country, particularly gold bought purely for investment purposes. Second, to encourage people to shift a part of the gold they hold, or gold they might import for investment, away from inert physical metal towards more productive financial savings products.
Okay, let's break down the sovereign gold bonds, or SGBs, first. How do they work?
These are essentially government securities bonds issued by the RBI on behalf of the government of India. They are denominated in rupees, but their value is directly linked to the price of grams of gold. So, you invest in rupees, but your investment tracks the value of gold.
Who is eligible to buy them?
The sale is restricted to resident Indian entities only. This includes individuals, Hindu undivided families, HUFs, trusts, universities, and charitable institutions. They are available in both physical paper form and electronic DMAT form, making them easy to hold and trade.
Are there investment limits on how much one can buy?
Yes, there are limits. The minimum investment mentioned is equivalent to 2 grams of gold. The maximum limit is set at 500 grams of gold equivalent per person per fiscal year.
And unlike physical gold, they actually offer an interest payment.
That's a key feature, yes. SGBs pay a fixed interest rate on the initial investment amount. The source states the rate for the 2015-16 issue was 2.75% per annum, payable semi-annually, half-yearly.
What's the tenure or maturity period?
The standard tenor or maturity period for the bond is 8 years. However, the scheme includes an early exit option for investors, allowing them to redeem the bond from the 5th year onwards on specific interest payment dates.
Do standard KYC norms apply?
Yes. The usual Know Your Customer requirements, similar to those for purchasing physical gold, apply when buying SGBs. A significant benefit highlighted is a potential tax advantage. Exemption from capital gains tax is available if the bond is held until maturity.
How is the value calculated when the bond is redeemed at maturity?
At the end of the 8 years, the bond is redeemed in rupee value. This redemption value is equivalent to the prevailing market price of gold of the specified purity at that time. So the investor gets the benefit of any appreciation in gold prices over the holding period, plus the regular interest payments along the way.
The sources mention some initial success for these SGBs.
Yes, they note that in the first 2 tranches launched after the scheme began, they saw total subscriptions equivalent to 788 kilograms of gold, amounting to nearly 993 crore, coming from about 3.9 lakh applications. This indicated some initial public interest and traction for the concept.
Okay, then there's the other scheme, the Gold Monetization Scheme, or GMS. This sounds different.
It is quite different. The GMS was designed specifically to try and mobilize the vast amount of unused or idle gold that's estimated to be held by households and institutions within India. The figure often quoted, and mentioned in the source, is a staggering 20,000 tons. The idea is to bring this unproductive physical gold into the formal economy and put it to use.
What are its key objectives, including how it might help the jewelry industry?
There are several objectives listed. First, as mentioned, to mobilize that idle domestic gold. Second, to provide a boost to the gems and jewelry sector by making this mobilized gold available to them as raw material, potentially through gold loans from banks. And third, over time, to reduce India's heavy reliance on importing gold to meet domestic demand, which would consequently help improve the country's external trade balance.
How does the scheme actually work based on the draft guidelines mentioned in the sources?
Okay, the process described is, individuals or institutions take their physical gold, ornaments, bars, coins, to designated collection and purity testing centers, CPTCs. The gold is cleaned, weighed, and then melted down to conduct a fire assay test to confirm its exact purity. The depositor then has a choice. They can either deposit the gold into the scheme, paying a testing fee, or take their gold back in the form of bullion after the testing, again after paying a nominal fee.
Is there a minimum quantity required for deposit?
The proposal mentioned in the source was a minimum quantity of 30 grams of raw gold equivalent. Once the gold is deposited and its purity certified, the depositor receives a certificate stating the exact amount and purity of the gold deposited. Based on this certificate, the banks then open a gold savings account in the name of the depositor.
And this gold savings account earns interest?
Yes. Interest starts accruing after a certain period, maybe 30 or 60 days after the account is opened, depending on the tenure chosen. Interestingly, the interest rate itself is left for the individual participating banks to decide.
And how are the principal and interest paid?
This is a key point. Both the principal, the amount of gold originally deposited, and the interest earned are valued and denominated in gold terms. The example given is, if you deposit 100 grams of gold and the interest rate is 1% at maturity, your account would be credited with 101 grams of gold.
What about redemption? Can you get physical gold back?
The depositor has the option, but they must choose it at the time of making the deposit. They can opt to receive the redemption value either in cash, equivalent to the value of the gold balance at the prevailing price, or in physical gold. The tenure for these deposits is a minimum of 1 year, in multiples, and breaking the lock-in period prematurely is allowed, typically with some penalty.
Are there tax benefits associated with the GMS as well?
Yes. Similar to SGBs, the gold savings account under GMS is mentioned as being exempt from capital gains tax, wealth tax, and income tax. This makes it a potentially tax-efficient way to hold gold and earn interest on it.
The potential economic impact of successfully unlocking even a fraction of that estimated 20,000 tons of idle gold could be huge.
Absolutely. If the scheme could mobilize significant quantities, it could substantially reduce the need for India to import the 1,000 tons of gold it typically imports annually. This would have a very positive impact on the current account deficit and external balances. It could also lower the cost of gold as a raw material for domestic jewelers, potentially making them more competitive and boosting jewelry exports. The government, according to the source, was reportedly aiming to mobilize up to 60 lakh crore worth of this idle gold through the scheme, offering tax-free interest as a major incentive.
Was there a regulatory consideration mentioned for the banks participating in the scheme?
Yes. The sources note that it would be helpful for banks if there was clarity on whether the gold mobilized under the GMS could be counted towards fulfilling their mandatory CRR or SLR requirements. That certainty could influence their willingness to promote the scheme actively.
And what about the challenges in getting widespread public acceptance for a scheme like this, given people's traditional attachment to physical gold?
The sources acknowledge this is a major challenge. They suggest potential measures to ease concerns, such as initially making invoices mandatory only for newly purchased gold bars or coins, perhaps not for traditional household ornaments, to avoid deterring participation. Banks could still track transactions using address and ID proof for ornaments, but maybe raise questions only if unusually large quantities of ornaments are deposited to prevent potential misuse for money laundering. The material cautions that the scheme structure needs to be very carefully designed and communicated to succeed where previous, less successful gold deposit schemes in India did not gain much traction.
Okay, finally, let's confront what the sources describe as one of the most significant challenges currently plaguing the Indian banking sector: non-performing assets, or NPAs.
Yes, this issue is framed as one of the most severe problems, even raising fundamental questions about the stability and health of the banking system at the time the material was written.
Let's just reiterate the basic definition. What exactly constitutes an NPA according to the RBI regulations cited?
It's quite straightforward. An NPA is a loan or an advance where the payment of either the principal amount or the interest due remains overdue for a period of 90 days or longer. Once that 90-day mark is crossed without payment, the loan account has to be classified as non-performing.
And NPAs themselves are further categorized by the RBI based on how long they've remained problematic, aren't they?
Yes, there's a progressive classification system. First, they become substandard assets. These are loans that have remained NPA for a period less than or equal to 12 months. If they remain in the substandard category for another 12 months, they are then classified as doubtful assets. And finally, there are loss assets. These are loans that are considered uncollectible, their value is negligible, and their continuance as a bank asset is not warranted, even though there might still be some small salvage or recovery value possible.
The sources mention that the former RBI governor, Raghuram Rajan, played a particularly key role in bringing the true extent of this NPA problem out into the open.
Yes, he is credited with identifying the hidden scale of the NPA problem as a major systemic challenge shortly after he took office. It seems the problem had previously been somewhat masked by banks engaging in what's termed window dressing accounting practices that made their balance sheets look healthier than they actually were, perhaps by restructuring loans in ways that avoided classifying them as NPAs.
So he pushed for a cleanup.
Exactly. The RBI, under his leadership, initiated an asset quality review, AQR, across banks and urged them to clean up their asset books thoroughly, recognizing and classifying bad loans properly, setting a deadline of March 2017 for this process.
And that forced cleanup had a dramatic, visible impact on the reported NPA numbers.
It absolutely did. It brought the true scale of the problem sharply into focus. The sources cite a stark statistic. Just 29 public sector banks alone wrote off a massive euro 1.14 lakh crore in bad debt between the fiscal years 2013 and 2015. That was more than the total amount they had written off in the entire preceding 9 years combined.
Looking at the overall magnitude based on the FY16 data cited in the sources, the numbers are quite alarming.
They really are. For 39 listed Indian banks at that time, their gross bad loans, total NPAs before provisions, surged by a staggering 92% in that 1 year to reach 5.79 trillion. Their net bad loans, which is NPAs, after deducting the provisions, banks have set aside more than doubled to reach 3.38 trillion. Across these banks, the average gross NPA ratio jumped from 4.41% to a very concerning 7.91%, and the average net NPA ratio rose significantly from 2.45% to 4.63%.
And public sector banks, given their size, bore the brunt of this sharp rise.
Yes, with their roughly 70% market share, they were disproportionately affected by the surge in bad loans, often linked to large infrastructure projects that had stalled. The sources note that at that time, 2 specific PSBs had gross NPAs exceeding a very high 15%, and another 8 PSBs had gross NPAs that were close to or above the 10% mark.
The Economic Survey for 2016-17 explicitly linked this burgeoning NPA problem to what it termed the twin balance sheet TBS problem. Can you unpack that?
Yes. The twin balance sheet problem refers to the dangerous interconnected issue of having, on one hand, large corporations that are over-leveraged, they took on too much debt, often during the economic boom years, and on the other hand, banks whose balance sheets are severely impaired by the bad loans, resulting from those companies struggling to repay their debts when projects stalled or the economy slowed. The two problems feed off each other.
And the limited success at that point in resolving these large, complex NPA cases was creating a negative feedback loop for the economy.
Exactly. As NPAs piled up on bank balance sheets and locked up capital, banks became much more cautious about lending new money. This led to a significant slowdown in credit growth, particularly to crucial sectors like industry and MSMEs, which the sources say fell to 2-decade lows around that time.
And that credit squeeze has real consequences.
Absolutely. It directly impacts investment. Private investment turned negative, and overall investment growth stalled. This creates a serious drag on the entire economy. The sources emphasize the urgent need for a decisive resolution mechanism to break this cycle before the twin balance sheet problem severely hampered India's growth prospects.
Okay, so given the severity of the problem, the sources also detail several tools, laws, and specific plans that were implemented or proposed to try and tackle this NPA crisis. The Sarfazi Act of 2002 was an important early legal framework.
Yes, the Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act, 2002 Sarfazi, was landmark legislation. It was specifically designed to empower banks and financial institutions to manage and recover their bad debts much more effectively than under previous laws.
What were its key mechanisms?
It provided a proper legal framework for securitization activities, bundling up loans and selling them. It laid out procedures for transferring NPAs to specialized asset reconstruction companies, ARCs, for focused recovery and resolution efforts. But perhaps one of its most powerful features was enabling banks and financial institutions to enforce their security interest, meaning they could take possession of or sell assets like property or machinery that had been pledged as collateral for the loan without necessarily requiring intervention from the civil courts at every single step, which used to cause huge delays.
So it significantly sped up the recovery process for secured loans.
It aimed to, yes. The Act also provided detailed provisions for regulating these ARCs, with the RBI designated as their primary regulator.
A more recent and arguably more comprehensive mechanism established is the Insolvency and Bankruptcy Code 2016 IBC, which is overseen by the Insolvency and Bankruptcy Board of India.
Yes, the IBBI was set up on October 1st, 2016. It's quite unique because it acts as the central regulator, not just for the various professionals involved in the insolvency process, like insolvency professionals, insolvency professional agencies, and information utilities, but also for the insolvency transactions themselves, covering corporate insolvency and liquidation, as well as individual insolvency and bankruptcy, all under the umbrella of the new code.
So it's a crucial pillar for implementing this new consolidated code.
Absolutely. The Insolvency and Bankruptcy Code, IBC, was a major reform that consolidated and streamlined numerous scattered laws related to corporate reorganization and insolvency resolution into a single modern framework. Its primary aim is to ensure a time-bound resolution process.
And what are the stated objectives of the code?
To maximize the value of the assets of the distressed company in a timely manner, to promote entrepreneurship by providing a clear exit mechanism, to ensure greater availability of credit in the economy, by improving recovery prospects for lenders, and critically, to balance the interests of all stakeholders involved, creditors, debtors, employees within this structured, time-bound process. The sources also note a specific regulatory amendment made by EVBI around that time to ensure that the background and financial credibility of potential buyers, resolution applicants, looking to take over insolvent companies are properly scrutinized by the Committee of Creditors before they approve a resolution plan under the code.
The IBBI board structure seems to reflect its coordinating role with government officials and an RBI nominee.
Yes, it brings together key stakeholders to oversee the implementation and functioning of this crucial new resolution framework for stressed assets.
Then there was the Indradhanush Plan, announced by the government in August 2015. This was described as a comprehensive reform package aimed specifically at revamping the public sector banks.
Yes. The Indradhanush Plan, meaning rainbow, referring to its 7 components, was a direct response to the deteriorating situation in PSBs, which were particularly hard hit by NPAs resulting from large corporate and infrastructure projects stalling. It recognized that PSBs needed a systemic overhaul to address issues like lower profitability, high bad loans, and governance challenges. It outlined a 7-pronged strategy, the 7 colors of the rainbow.
Okay, let's quickly run through those 7 elements. First was appointments.
Right. This involved key governance changes like separating the posts of chairman and managing director in PSBs, designating the CEO as MD and CEO, and appointing a non-executive chairman, aligning with global best practices of the checks and balances suggested by the Companies Act. It also aimed to revamp the selection process for top management to be more transparent and meritocratic, even opening up the possibility of appointing MD and CEOs for the top 5 PSBs. PNB, BOB, BOI, IDBI, Canara Bank were mentioned from the private sector.
Second, the Bank Board Bureau, BBB.
Yes. The BBB was established as an autonomous body composed of eminent professionals and officials. It was tasked with replacing the previous appointments board for selecting whole-time directors and non-executive chairmen for PSBs. It was also meant to engage with PSB boards on developing business strategies and addressing governance issues. Its structure included a chairman plus 6 members, a mix of officials and experts, including 2 from the banking sector, with the RBI governor involved in the search committee for its members. It was seen by some as an initial step towards potentially creating a bank holding company structure for PSBs in the future. Third, and very importantly, capitalization. Absolutely crucial. The government committed to infusing significant capital into the PSBs to shore up their weakened balance sheets, helping them absorb the NPA losses and meet the stringent Basel III capital adequacy norms. A fund of 70,000 crore was planned over 4 years. The sources mention a specific infusion of 25,000 crore in one particular fiscal year, with 20,000 crore injected in just 1 month, and a cumulative total of 51,858 crore infused by the first half of the fiscal year 2017-18. This capital was vital for stabilizing the PSBs.
Fourth, de-stressing the bad loans.
Yes, a direct acknowledgement that tackling the NPA problem head-on was a core component of the Indradhanush plan. This involves supporting various resolution mechanisms.
Fifth, empowerment of PSB management.
The government pledged non-interference in the commercial decision-making of PSBs, encouraging them to take independent decisions based on commercial interests. It aimed to create a clearer distinction between legitimate government oversight, intervention, and undue influence, interference. Banks were also asked to establish robust internal grievance redressal mechanisms. The plan also mentioned seeking ways to make hiring processes more flexible and even considering employee stock ownership plans, ESOPs, for PSB management to better align incentives.
Sixth, a new framework of accountability.
This involved introducing new key performance indicators, KPIs, for PSBs to more effectively measure and boost their efficiency and performance, replacing the older, often seen as less effective, statement of intent SOSA system. The goal was to hold management accountable for results while assuring their independence on commercial considerations.
And seventh, governance reforms more broadly.
This element encompassed initiatives like the Jan Sangam conclaves, high-level brainstorming retreats involving all stakeholders, including the Prime Minister, Finance Minister, RBI Governor, and bank leadership. These focused on key strategic issues like capital planning, digitization, risk management, improving managerial performance, and driving financial inclusion. Follow-up conclaves were planned to track progress on decisions made.
The Indradhanush framework is described in the sources as perhaps the most comprehensive reform effort undertaken for PSBs since their nationalization back in 1970.
Yes, its ambition was quite sweeping, to fundamentally reform their governance, capitalization, accountability, and operational freedom, aiming to equip them to compete effectively and flourish in the rapidly evolving financial landscape of India.
The Economic Survey around the same time also put forward a more radical proposal specifically for dealing with the largest, most complex NPA cases, the PARA.
Yes, the Public Sector Asset Rehabilitation Agency, or PPARA. This was a suggestion from the Economic Survey 2016-17. The idea was to create a centralized agency, essentially a government-backed bad bank or asset management company, that would take over the largest and most difficult stressed assets from the books of the public sector banks.
Why a separate agency? What was the thinking?
The rationale presented was that a dedicated centralized agency might be better positioned to make the politically tough decisions often required to resolve these very large, complex corporate debt situations, decisions involving significant haircuts, losses for lenders, or forcing changes in management. It was proposed as a different approach to try and tackle the core of the twin balance sheet problem head-on, given that the progress using existing mechanisms for these very large cases had been somewhat limited up to that point.
And finally, as a concrete step towards that consolidation strategy discussed earlier as being necessary for strengthening PSBs, the sources mention the significant merger involving SBI and its associate banks.
Yes, this was a major move. The government approved the merger of 5 of State Bank of India's large associate banks, namely State Bank of Bikaner and Jaipur, State Bank of Hyderabad, State Bank of Mysore, State Bank of Patiala, and State Bank of Travancore directly into their parent bank, State Bank of India.
And this became effective from April 1st, 2017.
Correct. Additionally, the Harathia Mahila Bank, a smaller specialized PSB focused on women, was also merged into SBI at the same time. This move was a very significant consolidation event in the Indian banking sector, creating a much larger, more powerful SBI entity, clearly aligned with the strategic goal of building larger, stronger Indian banks capable of competing on a bigger stage.
Wow. We have certainly covered a tremendous amount of ground in this deep dive into India's banking system. It's incredibly complex.
It really is. We've journeyed from the fundamental definition of what a bank is in the Indian context, looked at the multifaceted and all-powerful role of the Reserve Bank of India, mapped out the different layers of players, scheduled, non-scheduled, commercial, cooperative, public, private, foreign, and then explored the huge impact of those transformative post-1991 reforms.
Yeah, and we delved into the intricacies of how the system manages liquidity, that vital lifeblood of the economy, using tools like CRR, SLR, repo, OMOs. We spent time on the crucial ongoing mission of financial inclusion, the debate on how best to achieve it, and the various initiatives like PMJDY, SFBs, and payments banks designed to push it forward.
And finally, we confronted that major challenge, the elephant in the room, really, of non-performing assets, understanding the scale of the problem, the twin balance sheet issue, and the various initiatives like SARFIZI, the IBC, the Androtenish Plan, and consolidation efforts undertaken to address it.
Hopefully, this exploration has given you, our listener, a much clearer, more detailed picture of this absolutely critical sector that underpins so much of India's economic activity and future prospects.
It's definitely a system that's constantly evolving, trying to balance its historical legacies like the large public sector presence with the demands of a modern, dynamic, and increasingly globalized economy.
And as the sources consistently highlight, banking is truly the fulcrum of the economy. Its health, its efficiency, its reach are absolutely essential for driving growth and ensuring that resources flow smoothly to where they can be most productive. We've seen the significant progress made through reforms and the introduction of new structures aimed at both fostering growth and deepening inclusion.
Yet major challenges clearly persist, particularly around resolving legacy asset quality issues decisively, and the ongoing journey for Indian banks to achieve greater scale and competitiveness on the global stage.
So, given the crucial role PSBs are still seen as playing, according to the sources, particularly in areas like infrastructure development and financial inclusion, despite their identified weaknesses and the rise of private players, here's something to consider. How will that complex set of goals achieving commercial profitability, ensuring prudent risk-taking for stability, and fulfilling the vital mission of financial inclusion for inclusive growth ultimately be balanced in the future evolution of India's banking system? What specific trend or initiative that we discussed today, perhaps the ongoing impact of technology, further consolidation, the effectiveness of the new bankruptcy code, or maybe a renewed push on innovative financial inclusion models, do you think will be the most influential factor in shaping that delicate balance and enabling India's continued economic ascent in the coming years?
That's the multi-trillion rupee question, isn't it? A lot to think about as this dynamic sector continues its transformation.
That's all for this deep dive.